right. Good morning, everyone, and welcome to today's webinar. I am Jessica Cordero from Insightful Accountant and your host for today. Now, before we start, as you guys know, I want to go ahead and ask your question of the day. Just as everybody's kind of coming in and you guys are settling down in front of your computers, your phones, or your tablets, whatever you have in front of you. Okay. So for those already with us in the room, feel free to answer. Words. Feel free to kind of chime in on this. Okay. So I love this question because mainly I think like everybody could relate to this. Okay. So Mike, my question of the day would be, what is like a style or fashion trend that you regret, like 110% don't want to see in your old photos?
Hey, I know this body won't fit into it anymore, so I don't have to worry about it. But and I asked my dad, right, for these things, and he told me no. He says that's a fad. You're not getting them. But there were these things, and I'm going to say parachute pants. That's what we called them. It wasn't the MC Hammer stuff. There were these ones made out of nylon that had zippers and things on them.
Yeah.
And all my friends had them, and they were the coolest thing. And they kind of swished.
They
Like,
rub.
they rub when you walk. And this was back in the 1900s, right? Back in the 1980s. And so I ended up getting a pair from a friend
Oh.
and wore them, and my dad cut them up and threw them away.
Oh no.
He wouldn't let me wear
Sorry,
them.
friend.
He was too tight, but yeah, that is something I did not want to see come back.
Yeah, I hope so. 'Cause I remember having really baggy pants back in the 90s, and it was not fun for me. Well, no, I wanted one, but my mom would never let me get them. That is the one main thing too. She said, you will regret that in all of your pictures. Do not get them. Whatever you do, don't get them. Well, thanks, mom.
Very funny.
Yeah. All right. Well, thanks to the parents for not letting us wear the ridiculous outfits that were in at the time. All right. Well, good morning again, everyone, and welcome to today's webinar. Again, I'm Jessica Cordero from Insightful Accountant and your host for today. Now, in today's Cash Flow Mastery Talks, we'll be talking about financing options and cash flow, making the right choices with the amazing Mike Milan. I will hand this off to him in just a little bit after I cover a few of the housekeeping items. Now, there is no CPE for this, as it is just a 30-minute webinar. And if you have any questions, please enter them in the Q&A panel. You know the drill, to remember to be specific. Don't just say, hey, Mike, what you mean? You got to ask, hey, Mike, what do you mean by you absolutely hate those pants? Mainly because they might not get to your question right after you put it in there. And we will be sending you a copy of the slide deck and a link to the recording right after the webinar. And it's also going to be up on our YouTube channel within about 24 hours. So if you want to go check that out over there, along with many other webinars that Mike has done in the past that might be of interest to you. I'll also be putting that link to our YouTube channel right into our chat. And also do not forget that we have many webinars for you every month, whether you're interested in practice management, marketing, everything tax, or all things QuickBooks. Insightful Accountants got something for you. Now you can check out all of our webinars that are available to you over on our educational webinars page right on our site. And I'll also be putting that link into our chat. All right. Well, speaking of webinars too, mark your calendars for Insightful Accountants Future Forward Integrations and Workflows on May 21st, 22nd, and get ready for 8 exciting webinars over 2 days where each is eligible for a CPE certificate. Now, don't miss out on this opportunity to enhance your skills and stay ahead in the industry. And if you haven't subscribed to our newsletter, you got to just join the tens and thousands of accounting professionals who rely on Insightful Accountant to keep them up to date on news and updates impacting today's accounting profession. I'll be rolling out all those links and the copy of the slide deck throughout the webinar in case you might have missed it the first time I put it up there. So watch out for that in the chat. And Mike, that's it for me. Welcome and thanks for being here.
All right, Jessica, thank you very much. And live from Baton Rouge. I know I'm normally sitting in San Antonio, but obviously I'm in a hotel room. Baton Rouge. It is Baton Rouge Entrepreneur Week, and I am speaking this afternoon over the event. So, but before that, I'm spending time with you, and we're going to talk about financing options and way to manage your cash flow through financing. So, you normally don't get banking advice here, but you got to remember my background has been in banking, for, 15 years, I guess now, building software, training bankers, talking to bankers, working with you. So we are going to talk about financing options and give you some things that you can take today right back to your clients. So let's talk about why I'm doing this. Now, this is number 10 of the year, right? This is the 10th one I've done with Insightful Accountant, and I'm super happy with it because it falls right in line with my mission. My mission is to eliminate cash flow as a reason that businesses fail, right? I don't want you to fail for any other reason except for cash flow, because there's about 18,000 bankruptcies per year, and 35% of them have net profit on the books, right? So when you think about it that way, they're making money on paper but can't pay their bills. That's the problem that you and I are here to solve. And I hope you walk this mission with me because it's super important for everyone. Now, here's the first rule, right? The first rule that we talk about in financing anything is the one rule that's going to save you lots of bacon, right? It's the length of the loan should match the life of the asset. I'm like, going, Mike, what do you mean by that? Well, first of all, you got to look at the way the balance sheet is set up, right? That current assets are designed to pay for current liabilities, right? Cash pays for your credit card. But the sale of your fixed assets is designed to pay for your long-term liabilities. When you sell your house, you pay off your mortgage. That's kind of the way this is set up. And from the banker's point of view, that's the way they look at your balance sheet. Current assets for current liabilities, sell your fixed assets for the sale or the disposition of your long-term debt. The way to properly finance any asset is to match it with the useful life. So if you can depreciate something for 5 or 7 years, you should finance that. If you don't pay cash, finance it with a 5 or 7 year term loan. That way, when depreciation ends, so do your payments, and it's a good place to be in if you want to do replacement at that point in time. But that's the one rule that's going to save you money in the long run. Why do I say that? Because there is a concept out there called mismatch financing. Mismatching your financing. So when people goes, well, what does that mean? Well, you got to realize that you have to use the right loan product for whatever you're doing. It's for an example, would you buy a house with a credit card? Maybe somebody's raising their hand like, oh yeah, of course I'll do that. It's great miles. I mean, if I can get miles like that on a credit card, yep, I'll do it. Well, the reason why most people don't do it is because what are interest rates now? Short-term money is usually more expensive. Like credit cards are somewhere between 25 and 30% interest, where your mortgages are somewhere around 6, 7, 8%, right? So what happens to a business owner is that nobody ever walks out on their front porch in the beginning of the morning and says, I'm going to misfinance my company today. We don't do that. What we're trying to do is solve problems. That's all we're trying to do. It happened to me. I walked into the restaurant. I owned restaurants back in the early 2000s, and I saw one of the coolers leaking. If you know anything about these large coolers, I'm talking about 12-foot long, 2-foot wide. If you know anything about that you put your beer bottles and stuff down into, when the compressor goes, you pretty much got to replace the whole unit, right? And fixing it is just about as expensive as buying a new one. So I jump in the truck, I go to the restaurant supply store, and I say, I need a cooler. They tell me it's $6,500. I take my credit card out of the pocket, buy the cooler, put in the truck, go back, save the day, and also mismatch finance my company at the same time. How? Well, I put a depreciable asset, something that I can depreciate and is sitting on my balance sheet as a fixed asset on my credit card, a current liability, something I'm supposed to pay this year, and paid a lot more interest. I didn't realize it because I'm just making the payment. But this is one of the silent killers of, well, cash flow, because it sucks money out of your company in the form of interest. And a lot of times you don't even realize how much it is. But I'm going to teach you how to find it, right? So if you have clients, and what bankers are telling me right now is that 60%, roughly 60% of all small businesses that come into the bank have some type of mismatch financing. So in order to find it, this is how you can help your client, maybe save them hundreds or thousands of dollars per month, is use a derivative of the basic accounting formula, which is assets equals liabilities plus equity, right? So that's the balance sheet. Assets up top equals liabilities and equity. You can use a derivative of that equation to find it just by stripping away some of the things that you're not looking for, such as I'm only looking for a change in gross fixed assets. Specifically, it goes up. When gross fixed assets go up, in this case, 2.2 million to 3.4 million, well, they bought about $1 million worth of stuff, right? It went up. So what I'm looking for is a corresponding change in long-term debt or cash, right? Because that's the only way to really finance this type of asset is use long-term debt or cash. But I'm going to look for it in the change in long-term debt or long-term liabilities. But then the next one confuses people because I said, I'm also going to look for cash in the change of retained earnings. And people go, what? How is retained earnings also a change in cash? We got to realize what retained earnings are. Retained earnings is actually net profit that comes off the income statement and gets put on the balance sheet in the form of retained earnings, right? So I mean that's the profit. Well, the offset to that is cash. And you go, well, they don't equal. Well, it does equal because retained earnings is a result. All the operating expenses have been taken out. In cash, all the operating expenses and everything you've done has been taken out. What's left over is what you use to make your term loan payments. Believe it or not, that's where the money comes from. Term loan payments are made from net profit and from retained earnings. What that means is that when they being the bank, try to determine how much you can afford, they're looking at your EBITDA, which is your earnings, to determine how much you can afford, right? How much can you make in payments? Well, if that's the case, if you believe what I just said, gross fixed assets is I bought something, and if I did it right, I use long-term debt and cash. And if I did it wrong, these won't equal, right? Or be pretty close. You should be able to make an assumption of why it's not exactly close. Like maybe you put in more equity, or maybe there's money came in from one of the loans from the government, but that would be long-term debt. So in this case, we're just going to look at these three, the basics of it. Gross fixed assets equals long-term debt plus retained earnings. The change in long-term debt is 900,000 to 700,000. He actually went down. This person actually paid long-term debt down. So in order for this to be equal, I should see a massive increase in retained earnings. And retained earnings went from 1.3 to 1.4, so 104. Now, when I add those together, right, long-term debt plus retained earnings, I get negative 152,000. So all I have to do, if I'm the advisor or the accountant or the CPA, is match those two up. Does 1.2 million equal negative 152? Well, no, I mean, the answer is no, of course, right? I mean, they just don't equal. So this is what's called mismatch financing. You found it. All you have to do is introduce your client to the bank, right? And what they will do is help them restructure the loan. It's not adding new debt. It's just taking it off of the current liability, maybe the credit card, maybe a line of credit, and creating a term loan with it. So it's not new debt. It's just rebalancing it so you actually save money. Bankers love to do this because, well, it's a new loan. It's a sale for them, right? They're in the business to make loans. So that's a new sale. One way you could also help is you could ask the question, what did you buy? Gross fixed assets, and how did you pay for it? And chances are they may tell you, I use my line of credit or I use my credit card. Well, if that's the case, then you need to get them over to the bank and help them restructure. And you might be saving them 10% in interest or more. So that's mismatched financing. Now, here's the thing. I can't just tell you about mismatched financing and not tell you about how to actually structure debt in a company. Most people don't know this. There's no course out there that I can point to that says, here's how you structure debt in a small business. And I would have known this sooner, but I'm going to blame my mom, right? we blame our moms for everything, but I'm going to blame my mom. Mainly because when I started high school, you know, she had this big dream for me. She goes, Michael, she's probably the only one in the world who ever called me Michael. I think you're going to be a doctor. I think you should be a doctor. Then the scores started coming in, right? Biology, chemistry. She'd look at my report card and go, maybe a dentist. Right? And we kind of played this game all through high school. She went from doctor to dentist to accountant to chiropractor to the last thing in the world. My senior year, she goes, lawyer. I think you're going to be a lawyer. Well, none of those worked out, right? I ended up being a state trooper. But here's the thing. I would have known about debt sooner if she would have asked me a different question. She wanted me to be a doctor, an accountant, a lawyer, a chiropractor. All those folks have relationships with their clients, right? It's a relationship type business. And when you move away from that, you retire, your clients don't necessarily just fall in line with the same or the person you sell the business to. Sometimes they do, but they don't have to, right? I can pick a new lawyer. I can pick a new doctor. Well, if that's the case, it doesn't hold much weight as to why I would be interested in that type of business because it's not about debt. It's about the relationship. If you ask somebody a different question, like if my mom would have asked me, Mike, you should be a beer distributor, right? I would have got debt instantly. Now you're probably confused. You're like, oh, what do you mean beer distributor? How does that make any sense? Well, think about it. First of all, do you care who the CEO of the beer distributorship is? Unless they're your client, probably not, right? Because it doesn't matter. As long as whatever they're delivering gets to the stores, you're pretty happy with the beer distributor. Well, think about it. If you drive by their building, the big buildings out probably outside of town. They've got a building, they got trucks, they got forklifts, they got shelving, they got office equipment, they got stuff, right? And we call stuff in this business gross fixed assets. And when you have gross fixed assets and you don't use cash to buy them, you finance it with term loans. We just kind of went through that with mismatch financing. Well, where does the money come from to make your term loan payment? Well, that comes from net profit. That's how they determine how much you can afford, right? Net profit or retained earnings. Now, the second part, the second level, this is pretty easy to understand. But the second part is, if you can do the second part right, you will only ever have to buy like inventory one time, right? And you use a 5 or 7 year term loan to buy it. You're like, oh, wait a second, what are you talking about? Buy my inventory, the first part, in permanent working capital or base level inventory. What does that mean? Well, if you ever been to a gas station or a grocery store, and it always seems like they have enough of everything, right? Well, first of all, there's a calculation called PAR. PAR is periodic automatic reordering. And what PAR is it's about the average amount that you sell per month divided by the number of times you can get that in a month. For example, if I was selling at a bar or at a restaurant 80 cases a month of Budweiser, and I can get them once a week, I take 80 and divide it by 4, right? There's 4 weeks in a month. That means at any one point in time, every week I should have 20 cases of beer, right? If I had 20 cases of beer, then I should have enough. I should probably never run out, because on average, I'm going through about 20. Now, every week, I know what to order to. If I have 25 cases in the cooler, I don't order at all. If I have 15 cases in the cooler, I order 5. But I want to hover right around 20 at the beginning of the ordering cycle. That's base level inventory. That's the average amount that I'm going to get. I buy my first set, the first 20 of that, with a term loan, and we use retained earnings and profit to make term loan payments. Here's what happens. After that first week, I have customers coming in. They're buying Budweiser. And at the end of the week, I go in there and there's 7 cases of Budweiser sitting on the cooler floor. Well, that means I've got to order 13 to get back to 20, right? I have 7 plus 13 equals 20. Then the vendor brings it, delivers it, but gives me an invoice. Where does the money come from to make the payment on the invoice? Does anybody know? If you can guess, it should come from the customer, right? The customer who just bought the 13 cases over the period of a week have given me money. I take their money first and make the payment to the invoice. Whatever's left over, I use for operating expense and profit, right? What I just described was gross profit, right? I have sales for the Budweiser. The customer gives me the sales money. I go pay for the replacement cost of goods sold, the inventory. Whatever's left over, I use for operating expense and profit. If I do that, I've only ever bought it once. I bought the first 20. After that, the customers have replaced it. But here's the thing. It never stays at 20, right? Think about the beer distributor. There's certain times a year that they need more. They need more than 10, more than 20, I mean, because there's the Super Bowl, there's St. Patrick's Day, there's 4th of July, there's, all kinds of holidays, Memorial Day, Labor Day. When you look at it, the cycle of beer sales is kind of like this, right? Super Bowl, or Cinco de Mayo, St. Patrick's Day, 4th of July. Well, that means I need more, because this is the basic. Whoop, that's finger pencil's terrible. I'm going to erase that. That was absolutely terrible. But the base is 20, but on occasion I need more, right? I need more during the Super Bowl. I need more during St. Patrick's Day, Memorial Day, 4th of July. I need more. Let's say that I need 10 more cases just to meet demand during those special days, right? So certain weeks I've got to spend more. Well, where do I get the money? I'm using the customer's money to buy the first 20. Where do I get the money for the next 10? Right? Where do I get the money for the next 10? Deborah said Budweiser doesn't sell to terms on little guys. Yeah, right. That means you got to come up with money every week. When they bring the invoice, you've got to give them the money. That's right. Good job, Deborah. But here's what happens now. This is called seasonal working capital. This is when you need things just on a regular basis, like these holidays. And I use the line of credit to finance the 10. So I'll go use my line of credit checkbook. I'll buy the 10 extra. Here's the thing about the line of credit. Here's why people get in trouble with it. Because after Dodd-Frank, there's a big rule that says you have to pay down your line of credit to 0 one time a year and let it rest. That means don't draw on it. Well, it's super hard if you start carrying a balance. Think about your credit card. If you had a $10,000 credit limit on your credit card, but you carried a $5,000 balance, it reduced your ability to borrow. And if you had a big car repair at $7,500, you couldn't use that credit card because it didn't have enough room. That's the same thing with your line of credit. Well, because of that, you should use the customer's money. As soon as they buy these 10 units, you take their money first and pay down the line of credit, right? That's how you stay out of trouble with the line of credit and stay in good graces with the banker. Now, some of your clients are already in trouble. They're already carrying a balance, right? They already have a balance. Oh, went too far. They already have a balance. They're already in trouble. Now, most banks will give you a one-time get out of jail free card. And what that means is that they will take your line and convert it into a term loan. They call it terming the line. Most business owners, when they hear the terms terming the line, they think, oh my God, they just took it away from me. No, they took the balance off of it, converted it to a term loan, which really what they're doing is they're taking the balance from the seasonal working capital and putting it down into a basic or a permanent working capital loan. No new debt, just putting it in the right place so you can use the line of credit properly and it reduces your interest expense. So that's actually what they're doing. If they do this, now you're in perfect position to make this work. I'm buying fixed assets with a term loan. I'm using a term loan to finance my base level inventory. Every time I replace the inventory, I actually use the customer's money to make it. Now, some people are saying, well, Mike, I don't have inventory. Well, remember, I ran a hotel staffing company. What this was to me was payroll, right? It was a payroll expense. And when I had different seasonal needs for payroll, I used a line of credit to make that up. This still was in play. As soon as the customer gave me money for the invoice, I paid off the seasonal working line, or I paid back the money that I borrowed out of my own account to make the permanent working capital loan, right? Payments. So that's how you do it. If you structure business right, you only buy inventory once, you only really make payroll once. Other than that, you're using the customer's money to make all the subsequent replacements and payroll payments. Okay. I'm sure there was questions. If you have questions, Mike at cashflowmike.com. Happy to go through this with you. That mismatch financing, I have an app called the Clear Path to Cash. It's an app. It calculates this for you, right? It calculates the mismatch financing for you. It's also in my book, the 7-Minute Conversation, How to Do Mismatch Financing. So you can get it there as well. It's a free download on my website, cashflowmike.com. And let me talk to you just a bit about the balancing of short-term debt and long-term debt. We'll kind of finish there today. First of all, most people don't know how to even calculate this. Well, in terms of long-term debt, the bank uses EBITDA. Now, every chief credit officer or chief risk officer has their own little variation or derivative of this formula, but in general, they're going to take EBITDA times 3. So if you're making about $100,000 in EBITDA, and people go, well, why use EBITDA? Well, EBITDA is an actual true measurement of cash flow, right? Because it actually takes out all the effects of management decisions we make for depreciation, for amortization, so accounting type decisions, or financing type decisions, meaning that you could use debt to finance your company. I would use equity, maybe shareholders. You're paying interest, I don't. When we add it back in, it makes us look equal, right? It's a true equalizer. You could use double declining balance, and I use straight line for depreciation method. When we add it back in, we look the same, right? It takes out all the effects of these decisions that we make. But in general, across the country, 3 times EBITDA is going to get you in the ballpark about the most you can borrow. So if you've ever had a client that goes into a bank and gets declined, they ask for $1 million, the bank comes back and says, no, not $1 million, but we'll give you 500,000. Well, they're not negotiating. They're just telling you can only afford 500,000. So you can't go back and say, I'll take 750, right? They're just telling you that's about what that is. All right, so got here. Oh, key takeaways. I was reading somebody's AI notes, I guess. So that's kind of that's going to get you in the ballpark. Now, when you do 3 times EBITDA, you have to go to the actual balance sheet and see if they already have some, because now what we're looking for is the borrowing power. And again, this is something in the app or in the book that I teach you how to calculate as well. All right, short-term debt's a little different, right? Because you use a different loan product. It's not a long-term loan. It's a line of credit. This is the amount of money that you need for short-term debt is enough to cover the financial gap. Now, in other actual webinars here, I've covered the financial gap. It's either inventory plus AR minus AP equals the financial gap, or it's the amount that you need to cover payroll while you're waiting for money to come in. But the financial gap is theoretically the amount of time where you don't have enough money. You've made all your payments and you're waiting for money to come in. If your business has ever felt clunky, like you're always waiting for stuff to happen and doesn't run smooth, it's probably because the financial gap is out of whack. Well, there's a calculation that you use to determine how much money it takes to cover the financial gap. And that's the amount of money that you need in order to smooth it out and ask for in a line of credit. And that's something that I teach as well in those books. So in the end, the things I covered for you today, you can get a copy of the 7-minute conversation, which goes over mismatch financing. It goes over EBITDA and how you can actually calculate how much you can borrow from a long-term debt perspective. It's in this book. It's a free book. Just go get it. I also have other resources, some free spreadsheets and stuff to help you do this in my Facebook group. It's the Clear Path to Cash. If you haven't joined that, go there. In the guides, there's a lot of resources that you can get that are free, and you join a community of people that are trying to solve the same problems you are. I do have a podcast, Mike and Blaine. It's business, beer, and BS. So if you like hearing stories, it's one place to do it. And if you want to know anything about what I do or what I'm doing, you can go to mike@cashflowmike.com, send me a letter or send me an email, or go to cashflowmike.com and check it out. Love to have you as part of our group. Jessica, how'd I do on time? We do good? Look, even give back to you a couple minutes.
A couple minutes to spare. All right. Well, thanks everyone. And thanks so much, Mike, for taking some time out of your day to hang out with all of us. All right. And right before we close out the webinar, remember that we have a variety of webinars for you every month, and you can check those out on our educational webinars page. I put it in the chat quite a few times for you guys. And don't forget to check out and subscribe to our YouTube channel and newsletter so you don't miss out on news and updates that impact today's accounting professional. Well, thanks so much, everyone, for today, and we'll see you in next month's Cashflow Mastery Talk. All right. Bye. Have a good day.
Bye.